Hello, everybody. I can see there's people in here now, so just going to give it another minute or so, maybe, for people to drop in. But just while we're doing that, I'll just break into a small introduction. So some of you might know us. You certainly might know Clive, who is the person on the other screen there. So we are Veritas Advisory. We are chartered surveyors, qualified tax specialists. We operate nationwide and have clients overseas. We advise on property portfolios valued in excess of 3 billion to single asset spend of around maybe 50k. So we've got the whole breadth of experience there for all commercial property, really. Some larger clients down to single asset. We advise the whole process on capital allowances, so where solicitors, accountants, sometimes need advice, at whatever stage, we can come in and we can always sort out any issues that might crop up. CPSEs, contractual clauses, everything really. So we're there for the lot. Also, we've got, as I say, UK clients, overseas investors, corporates, individuals, private equity, tenants. We advise lawyers, as I say, investment agents, some of which are here today, accountants, and QS firms. And also we are part of the esteemed CPN, which I know all you are. So it's good I can see some people have joined and some familiar names in here already, which is great. So without further ado, yes, and if you've got any questions, put it in the chat on the right hand side, and we can answer them, as we go along or at the end. But yeah, feel free to chip in. So if the technology is working, hopefully it is. We have been through it twice, myself and Clive, to make sure. So let's go on to the first slide. So first off, who can claim the tax relief? But basically, what are the assets you can claim? And I've just put some pictures up there. It's everything in there. In those 5 pictures, the cruise ship is quite a large one, but there's millions of pounds within there of tax relief. So everything you can see, you've got gyms, coffee shops, all across the spectrum. I've chosen retail here and leisure. So all your gym equipment that will qualify for tax relief, coffee shop, your signage, all your furniture there, your tables, display equipment, and down to your cruise ship. So what do we mean by tax relief? So a company, they create profits. They obviously have to pay tax on those profits, unfortunately. And at the moment, it's gone up to 25%. But what capital allowances is, at the end of the day, take out all the complications, it just leaves more money in your bank account for less payment in tax. So you've got a tax bill. What we do is we go in, we identify and value all those items which I've just mentioned there, and then produce a report which then decreases that tax liability, and in a lot of cases, hopefully down to zero, and even save some up for future. So it really is very valuable. And then going to the extreme there, I just thought I'd put in a cruise ship, which I think some of them go up to like £1 billion these days. So if that cruise ship costs you £1 billion, at current rate of corporation tax, 25%. So that's going to be £250 million worth of tax relief. So the net cost of that cruise ship, instead of £1 billion, is 750 million, and that is the crux of it, really. That's the bottom line of it. What can you get it on? So you can get it on everything commercial, apart from your residential dwelling. So you can't get it on your house, effectively, and that's it. Looking at it very simplistically. What expenditure? So there's two elements to this. So we've got a purchase of a property. So when you buy a property for £1 million, in some cases we find 20 to 40% of that, sometimes lower, sometimes maybe a bit higher, of that qualifies for tax relief. So what we do, you buy a property, you spend £1 million on it, we go in there and we value all those items that qualify for the tax relief. So looking at the pictures again, you've got all those assets there. So if you bought a coffee shop, we can go in and we value the signage, we value all the furniture, the M&E, and all that qualifies for the tax relief. And then we apportion that to your purchase price, and then produce you a report, which then you can decrease your tax liability based on those qualifying items. Also developing, extending, refurbishing, fitting out. So if you've got a project on the go with lots and lots of nice qualifying assets, exactly as I say in the pictures, we go in, we identify that, and we can produce the report, which then goes in with your tax return, I should say, and then that lowers your tax liability, and that's basically what we do. So who can claim? So anybody who pays income tax or corporation tax. This isn't just limited to those who pay corporation tax. We do a lot of income tax payers as well, where they've got an even higher tax rate, sometimes at 45%, so they get even more tax relief on their properties. Where you've got corporation taxpayers, that's 25% as it stands. But really, it's never been so good in the capital allowances world. There's a lot of reliefs out there, which I'll come to in a minute. But as the tax relief, the tax rate goes up, which is not great news, obviously, generally speaking. But for us, it just means you get more tax relief because we apply those rates to what you're paying, basically. So you get, instead of 19%. At tax relief, you get 25% now, which obviously is more tax relief for you. So who can't claim? So anybody who doesn't pay tax, and in this case, we've got pension funds, not-for-profits, charities, government bodies. We can't really work with councils. They own a lot of property, but when they do sell to a taxpayer, there's certain advantages there, where we know if a council's got a building and they sell it, then whoever the next purchaser is, they might have a full claim on that building because they're the first person to own it, who are a taxpayer, so you get a full claim on it. Okay, so next slide. So this is just a very simplistic example of what capital allowances can do. So as I said before, you've got a profit of, say, £2 million. We're just plucking numbers out the air here. Keep them nice and round, £2 million without capital allowances. So you've got that profit, you can take off your costs, such as debt finance, costs of the business, which is £1 million. We haven't, just looking at the first column, sorry, without capital allowances, and then you don't make any claims. So in the eyes of HMRC, you've got tax of £1 million at 25%. You are paying 250 grand in tax. Thank you very much to HMRC. Be very happy with that. But then, with capital allowances, you've got the same example here. So you've got profit of £2 million. You take away those costs of £1 million, but we've come in and we've identified assets which qualify for capital allowances. And again, that's all your, from the pictures, all your furniture, all your M&E. And we've priced that, we valued it at £1 million. So that can be taken off as well. So therefore, that leaves you with no tax to pay whatsoever. So it's the difference of zero tax or 250 grand in that example, which I think shows just what it can do. Who doesn't want to save £250,000 there? So what's current? You'll hear in the budgets, there's a lot of talk about full expensing, super deductions, integral features, 50%, first year allowances, AIA. It is all within the guise of capital allowances. The government like to put different spins on it. They love to try to make things easier, but ultimately don't, and just make things a lot more complicated in terms of timings of relief. But that's not really something which you really have to worry about. That's down to us. So we work out, what you might have heard of super deduction. It's now that's now finished. Well, as of last year's finished, now turned to full expensing. That's a job for us where we work all that out, and effectively we give you the number, or your client the number, to say, right, this is your tax relief available. Go ahead and claim it. But all the talk in the budget, it's a bit of a political football each year. They do like to change it. They do like to tinker with it. And at the next budget, we always expect, we hold our breath and say, right, what they're going to do this year. But effectively, it is all tax relief, and it is all there for the benefit of the client. And as I say, corporation tax increase, it's gone from 19 to 25%. That's an increase of 32%. But in our world, for capital allowances, that's just more tax relief you can claim. So you're paying more corporation tax, but there is more tax relief available to you because it follows the corporation tax rate. The tax relief does. And again, there just some pictures just showing what is possible to claim on. So in all those pictures, you've got some nice lighting there, all your furniture, rugs, certain flooring, in retail. It really is, as soon as you look at something, certainly from a capital allowances point of view, we go in and we can spot these things, and even those costs which aren't entirely obvious, we go in and we get the absolute maximum. So next one, this is what's on expenditure. This is what you can get in tax relief. So let's go right to the really good one, which I'm sure everybody's heard of, land remediation relief at 150%. But what does that actually mean? 150% of what? So you've got £1 million and you've spent it on getting rid of some asbestos or Japanese knotweed. That's cost you £1 million. So there's your £1 million. You times that by the 150% rate, which obviously £1.5 million. So in the eyes of HMRC, you have spent £1.5 million. You apply the tax rate at the moment, which is 25%. And so at the top there, £375,000. That's what you will get deducted from your tax liability. And in certain cases, I think it's important to note where you can't absorb that in profits, so your company hasn't got that profit to absorb, then that, as long as you claim that within that first year of expenditure or in that relevant year end, you can save that for future years. So you might not be paying tax for 1, 2, 3 years after, depending on the profits. So it's never wasted, it's always saved. So it really is important to get it claimed as soon as possible so you make the most of these first year allowances. And when I say first year allowances, that means you've got 2 years to claim it effectively. And for any accountants there, that means the end of the amendment period before your accounting year is closed off, where you can then only claim it going forwards, and you've lost the ability to claim it all in the first year. So that 375 will be gone. It will probably go straight back into right at the other end of the spectrum into 3%. So that falls into the 3% pool. So you've spent £1 million, you times it by 3%, the measly 3% there, and then apply your tax rate of 25%, and you get 7,500 knocked off your tax bill. So it really is the difference between 375 grand and 7,500 in that example. So you can see why we always go on and say, get those allowances claimed as soon as possible. And the other examples there, first year allowance, 100% full expensing. So you spend £1 million, 100% is qualifying in the first year. So times by the tax rate, and that's where your 250 grand comes from, etc., etc. Until you get down to that measly 3% on structures and buildings. Structures and buildings allowance is, walls and things, ceilings, things seen in the eyes of HMRC anyway to be structural. So moving on. And this is just an example of an asbestos roof that we did. So see the roof's off there. The contractors cleared it. The client spent an awful lot of money getting rid of it. Just a couple of notes there. If you actually suppose not in the case of asbestos, but if you cause the pollution, then you can't claim it. It's not seen as cricket in the eyes of HMRC, that you can't, if you cause the pollution, you can't claim the tax relief on it. And also another point there, it's available to both investors and developers. So if you're a developer and you clean out asbestos roof, then you do get it at a reduced rate. I think it's 50% instead of the 150%, but it's still pretty lucrative. So moving on. So this is a pretty numbery slide, so my apologies for that. But basically, all it's saying is what I was going back to before, is it's those first year allowances and how important they are. So just as an example, you've got a 5-year hold on a BTR scheme there at £90 million. So if you do not claim the allowances and taking advantage of those first year allowances, so in the top there, you've got type of allowance, you've got the main rate pool and the special rate pool. They're certain assets which you put into those different pools. Just to explain briefly, the special rate pool is things M&E, which have slightly longer lives. The main rate pool are things like carpets, fire alarms, security. So there's certain assets which go into those pools. But if you don't claim that in year one, you've got 0, 0, 0, and then come exit strategy, and you're only thinking, oh, well, best claim some capital allowances here. In year 4, you've missed the chance to claim all those first year allowances. So you've got in year 4, you claim 390, and then another one in the exit. So you've got £740,000 worth of tax relief versus below £3.8 million, and that's where the first year allowances really come into play. So you've got the main pool, special rate pool. You can fully expense that in the first year. That's what the government's just brought in, and you can see that within year 2, you've claimed everything. So there's nothing to claim going forward. They sit in the accounts 0, 0, 0, and the exit strategy, they're all claimed sitting there. Very nice. Special rate pool, that's your M&E, so you get 50% of that. So in year 1 and 2, you get an awful lot of those allowances, and then that carries on into year 5. You've still got a small remainder of that left. Now the AIA, where you can't claim, so the flip side of the 50% on the special rate is there's another allowance under annual investment allowance, which some of you might have heard of, is up to £1 million. So what you can't claim on the remainder of the special rate pool, the other 50%, you can put into the AIA pool up to £1 million, and you get that per year. So in year 1, there's £1 million there. Year 2, there's £1 million there. So the ultimate there, right at the bottom right, is you've got an extra, when you come to sell the building, you've got an extra £3.1 million worth of tax relief, because you can claim this off capital gains as well. When you come to sell the building, you've got an extra 3.1 million. So a lot of people think, because we're not paying tax yet, we're not profitable, let's save the capital allowances till later on when we can think about it. That really is the wrong way to think, because you're missing out on all those first year allowances, and the numbers speak for themselves there. Who wouldn't want an extra 3.1 million in that example? Oh, I've missed out on the poll, actually. Sorry about that. I've just got into the spiel. Apologies about that. So let's just do one now. So the first one here at the top, which I think is, we've got 3 answers there. How much extra did the Chancellor give? Say he was giving extra away. So 10 billion, which we've got 3 answers there, which is great, because that is the correct answer. So on top of the 20 billion, which the tax relief, which the UK already had in tax relief, so that he's added an extra third of tax relief to all taxpayers, which is great, and obviously that's extra sort of work for us, if you like, but we really want that 10 billion to be claimed. The amount of companies across the UK that don't claim the tax relief is still pretty high, but we really want to clear that up and just get that tax relief in those tax returns. And then we've got another poll there, sorry, just catching up. How many of your clients raise the issue of capital allowances? So yeah, it's fairly miserable reading for us there. So we've got a few and none. So I would say, from my point of view, Clive might have a different opinion here, but that's just down to education, where clients, they assume that the accountant's got it covered or the solicitor's got it covered. Everybody's looking. I think there's a nice diagram at the end where it shows we fall in the cracks between the client, the solicitor, and the accountant. And everybody assumes that the other is doing it, when really they're looking at each other to say, right, this is the capital allowances situation. But really, unless there's someone, a specialist like us, looking into it, then I would always assume that it hasn't been looked into properly. Certainly on a disposal where there's those, or there's been a development or a fit out, you really do need a specialist looking into it, because as we've seen from the numbers, the benefit is just absolutely huge, and can mean the difference between paying absolutely no tax for quite a number of years, which I think everyone agrees would be great. So I think I've caught up there on the polls. Again, apologies, I've missed them out, but I will crack on. So complexities. Now, this again is something which you generally don't have to worry about, but it will show you just what we think about on these things. So Section 25 works. So that's works incidental to the installation of, say, electrical works. So looking at it very simplistically, so you put a plasterboard up, that's seen as structural, but there will be holes going in there for light switches, for lighting in the ceilings. So that is works incidental to the installation of electrical works. So we can claim on the cost, and that's something which we can get on something which qualifies for the very measly 3%. We can actually claim maybe around 5 to 10% of that for works incidental to the installation of qualifying assets. Same item could potentially qualify for different rates. So this is another one where, which is a good way to get us involved. So going back to the roof example for asbestos. So somebody comes in, they take a roof off, putting a new roof on. Looking at it simplistically, that is structures and buildings, and that's where 3% comes in. For someone with an untrained eye. However, we would look at that and say, well, that's an asbestos roof. You take it off, you're getting rid of that asbestos, whatever the costs are on that. And again, we're going back to the £375,000 worth of tax relief versus the 7,500, and that's the difference it can make. And even if the whole roof is not asbestos, say half the roof is, then the other half, somebody might say, well, the other half is structures and buildings allowance. Well, actually, no. We're improving the thermal qualities of that roof, so then we can then prove that is then going into what's integral features pool. So again, what we're doing is getting it out of that 3% pool, which is the worst pool, and putting it into first year qualifying pool. So you're getting all that expenditure in that first year. So that's where we can really make a difference to those project works. What we see a lot as well, incomplete cost information, design and build projects, where we see on cost analysis all the time, electrical works, £500,000, that's it, that's all we get. But where we would come in and we would split all that down, we'd go and survey the property, we'd look at it and say, well, actually, part of those electrical works is a fire alarm, which qualifies for a higher rate pool. We would always look to take the advantage and qualify those assets which qualify for the higher pools. And that's where we can come in, where an accountant, say, would look at that figure and they wouldn't really know what to do with it and split it down, where we would go to the nth degree and make sure we maximize the higher rates tax reliefs. Also, invisible qualifying expenditure, builders work in connection. So again, we're going back to those costs which aren't seen on a building schedule, where somebody comes in and they do some work, as in labour, so we can apportion part of their time and their cost to certain elements for those higher qualifying items. Another complexity which we found over the past few years, super deduction versus full expensing. So there's lots of hoops we have to jump through to get super deduction and full expensing, which is, when does the contract start? When was it signed? All these things we have to take into consideration to claim full expensing and super deduction. And if we can't prove that, then we can't claim those higher rates. And that is, the onus is on the taxpayer to do that. And us working for the taxpayer, that's something that we do, and we take great detail to make sure that's the case. We jump through all those hoops to make sure we get that higher tax relief. Add-on costs, professional fees, so QS, architect, all those qualify in the same proportion. So if you've got a project which 80% qualifies, plant and machinery, then, looking at it simplistically again, 80% of those QS costs will qualify, which can add, 20% to the higher rate pools, which is what we would always try and do, as we say. And again, there just enhancing what I've said. So it really is down to, for those super deductions and full expensing, we've really got to look at when those contract dates are, date of first use. Even for the measly structures and buildings allowance, 3%, we still need to have those checks in place in order to claim. Otherwise, you can't, and HMRC will throw it out. So something which we think might apply, where you've got tenant leases, which I imagine a lot of you will deal with. So you've got your type of lease incentives there: reverse premium, capital contribution, rent-free periods. So where there's a reverse premium put in, so that's when the landlord obviously comes in, says, "Here you go, Mr. Tenant, here's some money," then that is taxed as income in the tenant's hands. They can go ahead and then do what they want with that money. If they want to put it on to a project or a fit out. And again, I've put some pictures there just showing, there's millions of pounds in those pictures there of capital allowances. Then they can claim the capital allowances on that themselves. They paid the money for it. So therefore, they can claim the golden rule in capital allowances: whoever pays the money gets the capital allowances. Then the next one, capital contribution. So that's the landlord coming in. They're saying, right, we will give you some money for your fit out or refurbishment. So as it's a contribution, the landlord can then claim the capital allowances on that. And a good thing about that is if we can, whoever we're working for, really, if we're working the landlord in that instance, then we would structure the lease so to say, okay, we're giving you, £100,000 worth of contribution, but we want the capital, we want that £100,000 allocated to the more lucrative allowances. So in those higher rate pools, so the landlord will be able to get that entire £100,000 for the high rate pools, and so therefore he's claiming the absolute maximum. That's usually what we see a lot when we're working for landlords. And then rent-free periods, obviously, that goes part and parcel sometimes. So on top of any capital allowances, then any tenant is saving on rent as well. Rent-free periods generally, that's an agreement between the landlords and the tenants, but obviously where we do have those reverse premiums in there and capital contributions, that's where we will come in and try and structure it to the best of our ability and get that tax relief in there. And just a little point of note at the end. So I think I mentioned before, if the capital contribution is paid towards the expenditure from the tenant, then the tenant can treat as non-taxable income receipt. Whereas if it was a reverse premium, they would have to pay tax on that as income. Whereas if it's a contribution, they don't. And also the landlord can claim capital allowances on it. And then that goes towards the base cost of that building. And then when the landlord comes to sell it, then they can also deduct whatever's left of those capital allowances from their capital gains tax. So it's a win-win. Okay, so when have we got the next slide? Next poll, sorry. I think one should hopefully be popping up. But anyway, I will crack on, I think. Oh, there you go. So how many of the lease deals has the tenant carried out as a fit out? So I'll just carry on here because I'm talking about refurbishments and things. So yeah, answers coming in. So just looking at this on a full refurb, what is the claim opportunity? So again, I put a nice picture in there showing carpets upright. And also you see some nice lighting and also all the ventilation there. You know, again, there's millions of pounds, you know, in that photograph of tax relief. So the reason why refurbishments are, you know, a lot higher in qualifying items is simply because you're going in there and you're putting in all the good stuff. So exactly as the photograph shows, you're not doing much structural work. So if you're putting up partitions, then yes, they're going to go in as SBAs, structures and buildings allowances. However, you can, if we have a look at it, we might be able to split that. So if a wall has got certain sound insulation or thermal insulation, then we can take part of that wall and put it into the higher pool, as I mentioned before. So Section 25 works again, any labour works in relation to electrical works, HVAC, we can also apportion that. So in this case, as an example, you've got £800,000, you know, spent on a refurb there. 85% is qualifying, so that's all your qualifying items, which I've explained. So that's 680k qualifies for capital allowances. You apply your tax rate of 25%, so there's 170k of actual cash savings. So really, the net cost of that refurb, instead of 800, by way of tax relief, is has reduced quite substantially to 630k. Now, those who get in early, they can actually use that as they wish, really. But I've seen a few times where they know what the tax relief is going to be, so they put that 170 back into the project to upgrade, you know, any way they see fit. So let's have a look. Just having a look at the poll there. How many of the lease deals has tenant carried out as a fit out? So we've got 50-50 there. So that would be quite relevant to all of you there. So where you know there is a refurb, you know there's going to be capital allowances there. So it really is a case of, at the moment, getting those first year allowances in place. You know, as I say, just because they might not be, if they're just coming in and they're a startup company, just because they're not paying any tax yet, it really is, they will be paying that tax. So to get those allowances in those tax returns, and it saves them, you know, thousands, hundreds of thousands, even millions of pounds in the future. So yeah, it's really important to get it in there. So I think I've gone through all the polls, and I will now pass on to Clive, who's going to talk about acquisitions. So over to you, Clive.
Okay, thank you, David. Good afternoon. My area which I'm going to talk about is acquisitions and disposals. So we're looking at what happens on the deals when you're buying or selling property with capital allowances. I think one of the key things to cover on this is that what we try to avoid is that capital allowances becomes an issue on the deal. Nobody wants that to delay the deal or stop the deal. However, there is sometimes quite significant value in the capital allowances. So what we tend to do with our clients is be very involved with them very early on, so we can assess the position from both sides and get that deal through. Quite often, we can actually structure the deal so that the capital allowances can be dealt with afterwards, as long as both parties are in agreement. Now, David's talked about spending money on new plant and machinery. When you buy a second-hand building, you're buying a building which contains plant and machinery, which could be quite old. But there is something in the legislation that allows you to claim that. So as long as nobody else has ever made a claim, they're not within the charge of tax, then you can make a claim on those allowances. It's quite a strange scenario that you could buy, say, a 1970s hotel owned by a pension fund. It's got really old boilers and lighting in it. And at the date that you buy it, you can value those as brand new. So it's a strange part of the legislation, but there is significant benefit to do so. So when we looked at, what difference does it make to the yield on a deal? And we quite often look at these when our clients are buying them. They factor in the tax relief, and sometimes it can make up to 1% difference. And that can make the difference between them going ahead with the deal or not. The other point I've got there, I've put in, is value of claims is increasing. This is mainly due to the construction costs of plant and machinery going up. Those have gone up, and therefore that affects the value. And I'm going to show you in a moment exactly how we would go about doing a calculation on an acquisition. As David mentioned, tax rates have gone up, therefore the tax benefits go up as well. And the final point on this slide is on buying from a developer or a new and unused development. That applies exactly the same as if you were to incur the expenditure yourself. So you can still claim the super deduction and the full expensing if you buy when it's new and unused. One thing that has changed over the last few years is that property companies, owner-occupiers, and offshore investors are having to pay more tax. So they keep changing the rules. So especially offshore investors, they now pay tax on their income, they bring their companies onshore, and they pay tax on sale as well. Because of this, they pay more tax. Therefore, the only way they can reduce their tax bill is using capital allowances. The same applies for UK companies, except they've got restriction on their interest relief and losses they can carry forward. Again, the net result is they claim more tax. So if they've got a property portfolio, we tend to review that to see if they can offshore offset some of that benefit. So let's give an example. So this is based on the example of one of my clients. They bought, as you can see, it's a travel lodge for £8.6 million. They sent me an email having a look at it. I had a look at the heads of terms, and I noticed from the purchase report that the travel lodge was built about 15 years ago. It was developed by the pension fund. They couldn't claim. So then we are unrestricted because nobody else has made a claim for those allowances. Now, again, this is where all the information you've got is, all the valuation you've got is £8.6 million of the purchase price. So then how do you value items such as plant and machinery that David mentioned, such as the boilers, the electrics, the sanitary ware, the reception desks, the carpets, the security? All these kind of items will qualify. So what you actually do, and this is what the HMRC will allow you to do, is you do a recalculation or a revaluation of that asset. You value the plant and machinery as it is brand new. The boiler is new, the electrics is new, the lighting is new. You value the building as brand new as well, the walls, floors and ceilings. It's quite similar to an insurance valuation in terms of a rebuild. And then finally, you value the land as if it was a clear site and you have permission to build that property. If you can see in my example, I've calculated the plant and machinery at 1.2 million, the rest of the building cost at 3.4 million, and the land at 1.3 million. Now, if you add all those three values up, they don't add up to 8.6 million. The reason they don't do that is because the 8.6 million represents a finished building with a tenant you're looking at the market conditions at the time and the yield and the rent. So the legislation allows you, or the valuation allows you, to take those three figures and apportion them up or down to the purchase price. In this case, those three items don't add up to 3.6 million, they're less. So we apportion each of the elements up. So your plant and machinery, you can see, goes from 1.2 to 1.8 million, building 3.4 to 4.9, the land 1.3 to 1.9, which then add up to the 8.6 million. What you claim then is the 1.8 million. So you're claiming 1.8 million on, it could be a boiler, which is 15 years old, the lighting, which is old, the reception desk, etc. In this case, that was worth £450,000. And this client had actually owned the building for a couple of years, had never made a claim. So within the time limits to make a claim in their current tax, in their last year's tax return, we put the claim in, and they're very happy to let me know that HMRC have actually paid that tax back for them. So sometimes it can be a cash flow, but in this case, they got £450,000 back from previous tax that they paid. The next example is where we're acting for a client who bought a property. The vendor was actually a taxpayer, but they're a low tax paying fund. Their tax rate was only sort of 3 or 4%. So typically they don't make claims. It's just not worth it. And also their investors are mainly pension funds and non-taxpayers. So we found out during the due diligence process that a taxpayer had owned it since 2005. We also found out that they'd done a fit out during their ownership in about 2013 and 14. And during the process, which I'll come on to in a moment, I'll explain, is that I looked in the contract clauses and I put in a clause that the vendor would assist us to make a claim. So the contract had gone through, we bought the property, I contacted the vendor and asked if we could do a claim on their fit out. I got their figures, I did the claim, and they passed the benefit to my client. Now, the other interesting fact on this is I've got there an overage claim. So this is where legislation changes and we have to look at different times and dates of expenditure. When people owned a building, what they put in. In this case, because they owned it in 2005, at the time of that, when they owned it, they couldn't claim on items like electrics and lighting and cold water. So my client could therefore do this claim on those items based on a similar calculation we did in the last slide to claim the benefit. Again, £7 million office purchase. We made a claim and we got a total cash benefit of £875,000. So about 12 or 13% of the purchase price. Again, the client wasn't really expecting anything, but from due diligence and actually looking at how capital allowances work, there was a significant benefit. This was another scenario where we acting for a client. They bought a large shopping centre. The vendor had put in a £2 election. So therefore, on the face of it, there was nothing to claim. However, we also noted that there was a number of capital contributions, those what David mentioned previously. And in the shopping centre, there was numerous capital contributions. I think it was about 12 or 13. Totaled about a few £1 million. And in this case, most of the capital contributions qualified for capital allowances. They have to be passed over to the next owner at whatever's left. So, for instance, if you've claimed £100,000 on a capital contribution, then you sell the following year, you used up 20%, you have to pass on the remainder. In this case, we claimed about 3.5 million, and to a REIT, they can use it to retain some of their profits. The benefit was about 3.1 million. So in terms of process and what you need to know. So if you're dealing with a client who's buying or selling a building, capital allowances does come up, or sometimes it's ignored. The first thing that comes up is heads of terms. If you're acting for the seller, ideally you ask them, have they claimed any allowances and what do they want to put in it? Ideally, they've claimed, and you say to them, put in a simple line of that the seller is going to retain all the benefit of the allowances and you get to keep them. On the other side, if I'm acting for a purchaser, I will ask them to put in a clause in the heads of terms or just a line to say the benefit of all capital allowances will be to the purchaser. Again, what you're doing at this point is you're setting out the position or the intention. This is the intention of the offer price and what's accepted based on the value of the capital allowances. Where it can get problems is if you don't agree. The next side of the process is, excuse me, is replies to inquiries. Now, if you look at a standard set of inquiries, you will find that at the very end, it deals with capital allowances. The standard responses in a replies to inquiries, and I'm sure David will agree with me on this, is quite often they're blank, or they're not applicable, or they're wrong. This is where we get involved in making sure that they're actually answered, so we can actually understand the position. We can find out if the vendor has claimed, what they've done, if they're going to pass any on, have they spent any money on the building. And then finally, once we've established the position, we look at the contract and we put in a contract clause applicable to what's going on. Typically, if our client has claimed allowances, we will tell them to put in something called a £2 election and pass on nothing to the purchaser. Conversely, if we're acting for the purchaser, we may put an assistance clause in and a draft contract clause saying you will pass all the allowances over. So some of the things we look at, and I've got that part of the slide there saying value and entitlement, is what we do is we start looking at a property and we start looking at who owned it. And this can go back to when it was first constructed. We look at the timelines, we look at the tax status of the ownership. We spend quite a lot of time on the phone to land registry, finding out previous owners, and then ringing them up and contacting them. The other thing we're trying to find out is who put assets in, and we find that by when were refurbs taken out on the property. When did the tenant put it in? Who put in the boiler? Who put in the lighting? Was it original, or was it a subsequent refurbishment or repair? What this allows us to do is to look at every element in a building and find out its current tax status and whether or not the next purchaser can make a claim. So I mentioned something called a Section 198 election. So this is really determines what the vendor and purchaser agree on the capital allowances. If, say, a vendor has made a claim, does nothing in the contract, does not sign an election, a purchaser then comes along and says, I'd like those allowances, please, and they can't agree, and the vendor has sold it for a profit, the purchaser has every right to go to tribunal and force the vendor to pay back all the allowances. And this does happen very occasionally, and it can be quite painful. If somebody's claimed £1 million worth of allowances and they have done nothing, the purchaser can come along and force them to pay them all back. So it's very important that if you're acting for a vendor, you put in this election. In point 1, if the seller has claimed, you agree a £2 election, you keep all that benefit and you pass nothing to a purchaser. Sometimes the position is where the seller may be not making any profit, or maybe a successful-owned company. He decides to keep what he's claimed and pass the rest to the new purchaser, and that's called something at tax written down value. The final scenario is where the seller can't claim, say they haven't claimed, as on my previous example, they haven't bothered, they didn't know, and in that case, we advise that the purchaser do an agreement with the seller that they will make a claim and pass all the allowances over to the purchaser. Now, there's no real time limit if you own an asset to making a claim. For instance, we deal with things like doctor surgeries where they built it 10 years ago, they've never made a claim, we can go back in, get the figures and make a claim for them. On an acquisition, you do have 2 years from completion to submit this election. So there is a time limit to doing that. Doesn't apply to all items, but certainly when you're buying and selling, you do need to consider the time limits involved. So just got a couple more slides to finish off. First one is why capital allowances are commonly missed. Well, most of the time it's because clients are either unaware, they don't have a detailed knowledge of the legislation, or they assume somebody else is doing with it. Quite often they assume their accountant is doing it, or they may assume their lawyer is doing it, or maybe their surveyor, but certainly quite often it's missed because nobody's dealing with it. It's not brought up at the time of the deal, or they spend the money. The client's very interested in doing the deal or actually refurbishing the property, and the tax thing is very much looked at afterwards. And that's quite a common thing. This week already, I've had 2 or 3 accountants ask me about doing quick figures for the end of the month because their clients haven't got round to telling them about their refurbishment. That's quite a common thing that happens. And it's not the accountant's fault. The client's very busy, passes the information to the accountant. They see all these additions in their accounts and they go, well, what's that for? And then the client goes, oh, well, I refurbed my property for 2 million. And then they haven't done the calculations. So other reasons, sometimes they might be loss making. As David mentioned earlier, companies may be loss making, so why claim the tax relief, or them having a low tax rate. And then finally, sometimes people think it's too late, or they haven't got any details of the costs. Again, we always look at those. Even if you haven't got any cost data, we can reproduce that cost data and put in a claim. So we have a poll, which is the last one. And again, the question here, which I was really trying to get an idea on from those listening in today, is what opportunity do you see? Do you deal with acquisitions and disposals, or do you do with fit outs or refurbishments, or all of the above? And we have some answers coming in. We'll just wait a minute for a few more answers. If everyone could give an idea of what kind of examples that they deal with. So we're getting some more answers. So I think, some people deal with everything, and some people deal with acquisitions and disposals and fit outs. Not many people do refurbs. So I think the key point there is that if you've clicked one of those, then capital allowances are potentially available or applicable to the deal. If you deal with an acquisition or a disposal, they should be dealt with at one point. If you're dealing with a fit out, they definitely can claim. So again, it's just trying to be aware of this for your clients in the future. So we're often asked, what do I need to send you to work out? What question do I need to ask to find out if these capital allowances and this tax relief apply to my client? So David talked about actual developments or refurbishments or fit outs. Typically, what we would expect to see is maybe a cost plan or a tender from the contractor, maybe some professional fees as well. So all we really need is to know that's what they've spent, that's the kind of project type, and then from that we can give a pretty good idea of the type of level of tax benefit. Give an example: if you said you're doing a £2 million office fit out, we would know that roughly £1.5 million would qualify for plant and machinery. The tax benefit could be sort of £300,000 to £400,000. On acquisitions, what we like to know is the purchase contract, ideally the lawyer's CPSEs, and maybe some details of the property. From that, we can make an assessment of what was agreed between the vendor and the purchaser. We can then maybe have a look at what refurbishments were done and the type of the property, and again, give an idea of an estimate of the potential value. We tend to work on a benefit basis, so a bit like sort of say something like rate savings or rates mitigations, so that We only ever charge a fee or do a claim once we know that there's some benefit to the client. We get asked lots of different questions. Every question is a good question, as can you claim, can you not? And we always welcome those, because then that's an opportunity to find out if there's a benefit to your client. So that's coming to the end of our presentation. Thank you for listening. If anyone has got any questions, please put them in the chat box. I'm just having a look. I don't think anyone's put any in yet, but if anyone's got anyone to ask now, please put them in. Otherwise, you have mine and David's details there. If there's anything technical, we're quite happy to send you some information. If you've got a question on any particular scenario, then please don't hesitate to ask.
I think also the slides will be available to you. I think they'll be sent to you, so you'll have them as well.
Great. Well, I think there's no questions, but thank you for coming along to the presentation today and for listening. Thank you.
Thank you very much.